So Kelly, can you explain the MEC again? I was meeting with this guy the other day and he asked that very question, like, can you explain the MEC, whatever you called that? He said, sure. So the MEC, M-E-C, stands for Modified Endowment Contract. My shirt needs to be ironed. I need to do the man version of ironing. Got that thing hot. Back in 1988 is when it was officially stamped with TAMRA, Technical and Miscellaneous Revenue Act. Now there were a couple things prior to, DEFRA was involved in this, but in 88 it was officially done to where life insurance for the first time had some aspects of it changed with that law. Prior to 1988, what individuals did, certainly what the wealthy did, is they could have, let's say, $500,000 of capital, and they could shove it into an insurance contract. They could start a new insurance policy, pay that as a one-time premium. So stroke a check and put $500,000 as a one-time premium into their insurance. And let's just say, for simple numbers, the insurance company would underwrite them for like a $100,000 policy. So they have a little bit of insurance and they've got a whole bunch of cash in the thing, and that money is completely protected in the exact same way that I talk about it now. See, TAMRA didn't change any of the benefits of insurance, only how we get the money into it. The reason they did this was, you can read it in the various reports, there was obviously a tax shelter. They could take $500,000, $1 million, $2 million one time into an insurance contract. That's a unilateral contract of ownership that can't be penetrated with a teeny little amount of insurance, and they call it a life insurance policy. Well, that's obviously for the extreme benefit of preserving and protecting all that capital. So what they did is they changed the rule. So today, if you do a one-time premium payment, it's called a MEC, a Modified Endowment Contract. Your contract is modified, and they get to treat that contract just like an IRA. So any money you put into it is now just like an IRA. If you go to take it out, it's an income distribution. But they didn't require how many years you had to pay. So here's the fundamental strategy behind how we do this, is we bleed money in typically over about a 10-year period of time as a minimum. Now, some are like, dude, we got products where you can do it in 5. I know there's always little tweaks you can do, but there's something, it's a give and take. There's something you're giving up. If you're condensing it really short, there's something you're giving up for a little bit of later. If you're insurance guys, I get it, I know, but for the most part, we look at about a 10-year funding. So if we have someone with $1 million that they want to slowly bleed into the insurance to not violate the MEC line, for simple math, we would do $100,000 a year over 10 years. We'd slowly move that scale from this pocket to this pocket. And here's the other thing that the government requires, is that there has to be more sufficient amount of life insurance. So you can't do a $100,000 premium and get a $20,000 life insurance policy. So there has to be a little bit more risk to the insurance company. So here's how we maximize this. Whatever the premium amount is, if it's 10 grand a year or 100 grand a year, we buy the smallest death benefit that the IRS will allow in order to still keep this cash working in such a way that we don't violate the MEC rule. If we're buying the smallest amount of life insurance possible, then we're keeping this policy as efficient as possible. This is how this works. It's not about the life insurance. It's about the cash. Just like prior to 88, it wasn't about the life insurance, it was about the cash. So that hasn't changed. The only thing that's changed is how we get it in there, and then we have to get a little bit more life insurance than they used to have to do in 1988. But notice what the politicians didn't change. They didn't change any other component. They didn't change one benefit. They didn't reduce any of the particular strategy with it. They didn't make it less competitive. Nothing. They just changed that one aspect so they could get a feel good. And now you just have to be a little more strategic with how you get your money into the contract. All right, so hopefully that clears that up. So if you'd like to hear exactly how you can do this and how it relates to you specifically, I have 2 ways for you. One is an audiobook. You can go to financialcaffeine.com and download that audiobook, and you can hear an entire simple recording of me where I go into the details of how this relates to you specifically and how you can implement it. Or if you would rather watch it and take some notes, etc., you can do that on financialcaffeine.com as well. I have a video called the Napkin Presentation, to where I have a camera overhead as I dialogue and as I draw it out. And then if you want to get access to me, you can go to financialcaffeine.com/survey, and you got some questions you got to do, but that'll get you access to me. All right. Thank you for staying with me this whole time. Know that you're loved. Know that you're blessed. Have a great day.